Hi, I'm Leo Popek, the founder and CEO of Leading Peers. Welcome to another Leading Peers Masterclass. In our Masterclass series, Leading Peers provides open and free access to education from experts to help CEOs succeed. Today, we will learn from Ivy Cohen, a business profitability expert and a member of Leading Peers. I've asked Ivy to share with us how CEOs can become better at understanding their business's key financial metrics and what they need to focus on to make their companies increasingly profitable. Ivy, it's great to have you. Take it away.
Good morning, everyone, and thank you, Leo, for having me today. I'm really excited to share with you some material that's going to hopefully help you grow your business. I am the CEO of my consulting firm called Business Profit Advisors, where I help small business owners get clarity around their numbers and drive their business, making it more profitable and valuable. So what I'm going to go over today is a little bit about helping you understand what numbers on your financials you're going to be looking at to understand your profitability. And I'm going to get into more how that works, a little bit of the math. And don't worry, it's not going to be an accounting lesson. I don't think it's a good use of a business owner's time to learn accounting per se, but there are some key metrics you need to know to be able to drive your business. So I typically work with business owners between $1 million and $40 million of revenue, privately owned. So a lot of my examples come from that arena. So let's get started. So you have 3 financial statements in your business. You should be able to print these from any financial reporting system. You have a balance sheet, a statement of cash flows, and a profit and loss statement. So today we're going to focus on the profit and loss statement, and we're also going to touch a little bit on the statement of cash flows. We're not going to have time to discuss the balance sheet. So this is what the profit and loss statement looks like. And what we want to do at the end of the day, what we're talking about when we say increased profitability, is adding some to the bottom line, to net income. In this case, we're going to say, what if we want to add 10% to net income? So before we get started on where to make those changes, let's just understand the key terms on our P&L statement. So it's called a P&L or profit and loss, or an income statement or net income statement. And here's an example for a service business, like a law firm. So the first line is sales or income or revenue, and that's what you bill clients for your services. It's not necessarily what you collect in cash, it's just what you bill them. And your cost of sales are costs that are directly associated with helping that client. Costs that you wouldn't have if you didn't have that client. So you wouldn't have those court filing fees. You wouldn't have that travel expense to the client. You wouldn't have any contract wages of people that are working specifically on that client. So that's the litmus test. If you didn't have the client, would you have those costs? And then sales minus cost of sales equals gross margin or gross profit margin. We're going to talk a lot about gross profit margin in this presentation, because that's the percentage of every dollar that you take in that is going to go to cover your operating expenses and to go to your bottom line. The next section is operating expenses, and those are all the other expenses required to run your business. So that's marketing and payroll, rent, insurance, etc. Now, for a service business, that's a service business. So for a retailer, if you're a retailer or a wholesaler, if you have any kind of product, there's some slight changes. First of all, sales income revenue is what you bill for your sales of your product. And cost of sales is often called cost of goods sold or COGS, C-O-G-S. And that is typically the cost of the item that you're selling. And that's what we call landed costs. So it includes all the costs that you incur to get that inventory landed into your warehouse. So it's inbound shipping, tariffs, duties, taxes, if you have to repackage it, if you're selling something like furniture and you deliver it to the customer, you pay delivery people, you're going to include that cost as well. Because again, if you didn't have that sale, you wouldn't have that delivery cost. Then everything else on the P&L is the same. So now, again, we want to add 10%. So where should we start? Well, most business owners that come to me, they come to me because they think that their business is not as profitable as it could be. And so the first thing they say is, I need to cut expenses. I feel like I'm spending stuff and I don't know where I think there's room for improvement. I need to cut expenses. So sure enough, this is an area that you should focus on. Any expense reductions that you make, they will go directly to the bottom line as profit. So that's great. So let's think about some of expenses that you could cut to contribute to a 10% increase in the bottom line. So you can look at your service contracts. Have they gone up over time? Are they different for different locations? Like, is waste management higher in one place than another? Rent, do you need to sublet out some of your space? Do you need to renegotiate with the landlord? Insurance, have you had it reviewed in the last couple of years? Employee benefit costs, are you using what you signed up for? Could you get a volume discount at this point if you have more employees? Bank fees is something that small business owners sometimes are paying a lot of money to send money overseas and receive money from overseas. The bank typically charges between $30 and $65 per transaction, but there's other websites you can use to be sending money back and forth securely that are costing a lot less. And office supplies, business owners aren't usually looking at this because it's a small section of a small expense, but they're also typically giving an admin free access to a credit card and buying stuff on Amazon. And if you had set up a vendor account with Office Depot or something, you might be getting better prices. So there's often cost saving opportunities here as well. Credit card fees. So if you take your total credit card fees paid, the merchant deposit fees, everything, and you divide it by your total sales, your total credit card sales, you should get a number that's less than 3%. If you get 3% or more, or anywhere close to 3% even, you should be reevaluating, because credit card fees creep up over time. And it is possible to negotiate with your credit card fee provider, and it's also possible sometimes to change providers without changing your system or your POS system. So shipping, anyone with a shipping business knows how big of an impact shipping costs have on your bottom line. It's something you're probably monitoring on a daily, weekly, monthly basis. And aside from negotiating shipping or changing carriers, there's things you can do in terms of, I've had clients switch ports that things are going through and have a huge impact of cost savings. You can also switch dimensions and packaging and the volumes you ship in. So you can think about all kinds of things, ways to save on shipping. Materials cost from suppliers. Are you getting volume discounts? Are you getting payment discounts? Do you have enough cash to buy in volume to get those discounts? And lastly on this list is, have you gone through things that you maybe purchased a few years ago and you haven't been using and not realizing? So maybe you purchased that plussed up Zoom subscription in 2020 and now you're no longer using it. Maybe it's something you could get rid of. So where do you start here? Which expense do you start with? So obviously you want to look at the biggest expenses where you think you can have the biggest impact. So, right, if your insurance expense is really big and you think even a 2% reduction in that could be a big impact, start there. But I want you to know that not all expense reductions are created equal. There are two kinds of expenses in your business. Variable expenses vary with the amount of sales that you have. So the more sales you have, the more variable expenses you have. So variable expenses are things like, obviously, cost of goods sold, but also the credit card fees, commissions that you pay your salespeople, things like that. All those costs go up. Every time you have a sale, you incur that cost. Whereas a fixed cost stays the same no matter how much your sales level goes up. So that's like rent, salaries, marketing, insurance. So variable costs will have a bigger impact on your bottom line profitability as your business grows. And I'm going to show you the math behind that. So this is a very simplistic example. So let's say that you have 25 customers and your rent is $25,000 a year. So each customer, you charge them $4,000 and it costs you $1,000 to fulfill that, whatever you're doing for them. So you have a margin of $3,000 per customer. So that's a 75% margin. You're earning $3,000 for every $4,000 you take in. You're 75% margin. And then that's what's left to cover your fixed costs, which is your rent. And so you have a $50,000 bottom line, $50,000 net income. Now, if you reduce your fixed costs, that's reducing your rent by 10%, you're going to save $2,500 on rent. And that $2,500 savings is going to go directly to the bottom line. Now, what if you cut your direct labor, which is a variable cost? It varies by the number of sales? What if you cut that by $2,500? Same 10%. Well, that is going to go directly to your bottom line. And so you see both bottom lines increased by 2,500. So what am I talking about when I said it was going to be more impactful to cut the variable costs? Well, what I'm talking about is when sales double or when sales increase. And so in this example, we're going to see all three scenarios with just doubled sales. But we didn't change anything else. And now you see that the cutting the fixed cost still yields that $2,500 savings to the bottom line. That $2,500 savings won't change no matter how big your business gets. That's all you saved. But if your sales double, you have a $5,000 savings when you had cut the variable costs. So again, variable costs incurred with each sale. So the higher the sales, the higher the variable costs. So focus on variable costs first in terms of cost cutting to have more impact as your business grows. So there's other expense reduction strategies you can look at aside from negotiating with vendors that we already talked about. But you can look at your expenses. When you look for cost cutting, look for non-strategic costs to cut. So if your strategic advantage as a business is your customer service, and that's why customers go to you because you have great customer service, don't cut costs related to customer service. Find a non-strategic area that you can cut. So you can also look at what adds value to your products and services. You can walk it down the line, what happens in every stage of the customer's experience or what happens in every stage of the product, and see where there's areas that you might be able to cut that aren't really adding value. You can lower your supply chain risk by diversifying vendors. I know a lot of the business owners out there that have products experienced supply chain difficulties during the pandemic. And also with the manufacturer, it's very expensive to set up a new supplier because you might have to set up a new line and new packaging. But that investment can yield at the end of the day for you. When one supplier raises prices, you're going to have an alternative supplier to go to. Or when one supplier has supply chain issues of their own and can't fulfill your order, you're going to have another supplier you can rely on. And this adds stability to your business and de-risks it. So that is an investment that can cause a cost savings for you. You can stock up on supplies when they're at a lower price and inventory when it's at a lower price. But again, you have to have the cash. And in terms of one of the areas that business owners tell me they have the most spending with the most uncertainty about the return they're getting on that spending is marketing. A lot of business owners ask me, like, I don't know if I'm, getting a good return on my marketing dollars. How do I know that? Well, you have to have a promotions plan in the beginning of the year. You have to have a plan of all the channels you're going to go down to get to your marketing goal. And you have to monitor the return that you're getting from each of those channels, like how many customers, how much revenue you're getting from each channel of advertising spend. Because at the end of the day, if you're not monitoring that, you might be spending money with no return on your dollars. So that's an area that you can evaluate and find cost cutting usually. So the next thing business owners say after they say, I need to reduce expenses is, I want to grow my business, so I'm going to increase sales, because grow my business and increase sales, like synonymous. So let's talk about how we can increase sales. So the extent to which a sales increase will impact your bottom line is going to depend on what your gross margin is. So you can increase sales, amazingly, but if at the same time your margin is being eroded, then at the end of the day, your bottom line is not going to change. I've had clients that have had increasing sales and end up with a negative bottom line while they're having increasing sales, because they don't realize that some of their variable costs are increasing and their margin is going south. So you can drive sales, but you also have to focus on margin to have that impact hit the bottom line. So 2 ways to drive sales. One is volume. So that's the number of customers that come to you, the number of times they come back, how much they spend each time they're there. And we won't have really time to go into volume today, but we are going to talk about price. So let's talk about pricing. So all business owners that I've worked with I've worked with them on pricing at some point in time, because all business owners, or most business owners I've worked with, are not sure about how to be strategic about their pricing. And they're very nervous that they're going to lose customers if they increase their prices, or if their prices aren't right, which can be true. We're going to talk about that in a second. But when your costs are increasing, if it's eroding your margin, that's the time when you have to think about if you should be doing a price increase. And you need to be strategic about the price increase. You need to do market research. You need to know what your competitors are charging. You need to look at it by product, and it doesn't have to be across the board. For every price increase that I've helped clients with, it's never across the board. It's always this high selling product is going to be increased in a different way than this low selling product, or high margin product, or low margin product, or a product they need to liquidate. There's a lot of considerations. So, but why don't you just increase prices though? Because that will definitely help your margin and your bottom line. So why don't we all just do that? The reason is, again, that fear of losing customers. So I'm going to talk about two things in regards to that fear of losing customers. One is I'm going to give you some ideas of ways to keep customers. And then I'm going to show you how to calculate the amount of customers that you can afford to lose if you increase your prices. So first, some ideas about strategic marketing communications and ways to drive sales before price increase. So all my customers that have done a price increase have announced it many months in advance, at least 3 months in advance, and at the same time announced a sale right before the price increase, so that, everyone wants to get last year's price, everyone wants to get this price because they don't know how much it's going to go up. So you can drive sales right before your price increase. You can also, when you increase your price, position your product differently in the market. So if you sell a thing for boats and you're selling it in fishing shops and dive shops and marketing to that audience of people with small boats, you might consider that if you market it at a yacht club or a marina with large yachts, that those customers are less price sensitive and they might not blink as many times about your price increase. You can also strengthen your pricing power by adding value. You can bundle multiple products with one higher price point. You can give them discounted or free shipping, gifts with purchases. You can provide a bunch of incentives for them to sign up for subscription models. And you can give them a better customer experience. You can, like, for example, Intuit recently raised prices on QuickBooks. But before they did, they sent out an email explaining all the additional services and everything that they've improved, that by the time they got to their not so big price increase at the bottom of the email, you're like, okay, I'm getting a lot more. So that's the goal in your marketing communications. But now let's do the math. How many customers can you really afford to lose? And I'm going to show you how to walk through this calculation. So again, a very simplistic example. You have 30 customers paying $1,000, and your cost to fulfill each customer is $400. So you're taking in $600 per customer gross margin, which is 60% of each dollar is going towards your bottom line. So let's say now you decide to increase your prices by 10%. So now your price is $1,100. Let's say you lost 10% of your customers. So customers went from 30 down to 27. So your total revenue decreased from 30,000 to 29,700. And then your bottom line, it actually increased. So even though you lost 10% of customers, your bottom line increased by $900 and your margin increased by 64%. Which typically, when you do a price increase, it will increase your margin. So it's increasing the percentage of each sales dollar that's going to your bottom line. So when you do this calculation for your business, if you do this calculation, the key is to make sure that you're using the right margin percentage. You need to know your margin percentage in order to get the right number for your business of how many customers you can lose. So now let's talk a little bit about gross margin. Let's say that you can't increase your prices. Your prices are market. You just did a price increase. Let's say you can't reduce your cost of sales. They're set in some way. And so are there any other ways you can increase your gross margin? So there's a few ways I'd like to point out. You can prioritize high profit margin items or services. So for example, a customer orders a low margin item and you can say that is going to take us 6 months to deliver that. But in 2 months, we can get you this higher margin item if you like. And so not only are you prioritizing you're encouraging sales of higher margin items, but you are prioritizing your staff's fulfillment time toward those higher margin items. Instead of spending that time like this week trying to fulfill a lower margin order, they're fulfilling higher margin orders. And you can target more profitable customers. You can review customer history and see which customers are buying at times that you don't have sales, which customers are buying at higher margins for specific reasons. They have specific contracts, whatever it is. And you can be more intentional about that as well. So now, what else can you do? Because we talked about lowering your operating expenses and we talked about your gross margin, your sales and cost of goods sold. So, but what else can you do to add to this 10% in your bottom line? Well, you can add efficiency to your business, and that is going to save you costs and add to your bottom line. And you also, having good cash flow in your business enables your business to be more profitable. So I'm going to just tell you about how both of those things work. So efficiency, to get more efficiency, you can't be penny wise and pound foolish when it comes to hiring. So we're all business owners. So we know how valuable it is to have that superstar employee and how much it can add to your business. So if you have a position listed out there for $80,000 and someone that wants $100,000 is applying to the job, you can consider that they may be actually twice as productive as the person that is applying for $80,000. And of course, focus on employee retention. We all know how costly that is in terms of our time and costs and our business. And so that's something that will add efficiency and productivity, lower turnover. And you can invest in streamlining and automating your processes. Again, like I mentioned before, you can scrutinize the whole process and see where there's unnecessary things going on that don't add to the value of the product or service. You can look to automate those things and determining what is actually moving the business forward and devote more time to those things and systematize the other things. But having systems and processes in your business actually provides your business with great stability. And this is in adding the value to your business when you go to sell it or hand it down to the next generation, or if you just eventually want to become an absentee owner. Your business has to be a stable cash generating machine that runs without you. And in order to get there, you need those systems and processes. So, any employee leaves, you have a system and process to give to the next employee. So let's talk about cash flow a little bit. So you need cash to fund ongoing operations. If you have enough cash, you can get payment discounts from suppliers because you can pay early. You can get volume discounts because you can buy more. So those are cost savings right there that you're getting by having enough cash to operate your business. You can give better terms. So you can get better customers. All these things that cash allows you to increase your operating profits. But also you need your operations to generate enough cash so that you have the money to make investments in the business. Those investments are going to allow you to add efficiency and to grow. So investments are like buying property, buying a new computer system, maybe investing in a training, investing in a new machinery, all these things that you need in order to grow your business and make your business more efficient. You need that excess cash to make those investments. So first, I just want to point out, it's possible to have a profitable business in a cash flow crisis. when you look at the profitability of your business on a consistent basis, but you don't look at the cash flow, I've seen multiple business owners get into a cash flow crisis by not paying attention to cash flow, especially if you have inventory. This can happen very quickly. Actually, your sales can be going up, up, up. In the meantime, your cash is going down, 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 and you don't realize it. And those are some of the situations in which I'm called in to help figure out. The business owner doesn't know why. What happened to cash? I'm so profitable, I don't understand. So we're going to talk about, to prevent this, a few things that you can be looking at on the cash flow statement. So first, before I get into this statement that's automatically generated by your accounting system, you need to do a cash flow forecast for 12 months. So you can see where you'll be in the down seasonal times with cash, in the up seasonal times. If you pay off debt, are you going to have enough operating cash to continue operating your business 3 months down the line? So something that you have to, that is very valuable and helps you sleep at night if you know where you're going to be 12 months, 3 months, 6 months from now, cash wise. So when you look at this cash flow statement, there's 3 sections: operating, investing, and financing. So operating is everything that you need to fund ongoing operations. So that includes everything that appears on your P&L is in the operating section. And that should be a positive number at the end of that section. Ideally, it should be positive enough to cover the investing and financing activities. So investing activities, that spending, it doesn't appear on your P&L. That's spending on equipment, on property, on systems, stuff like that, to add efficiency and to grow. So you need to make sure that, again, your operations, you have enough to cover your investing. And financing is just where you're getting the money, getting a loan, paying back the loan. So what do you do to monitor your cash flow and make sure that it stays healthy? So you need to be looking at AR. You could consider doing credit checks on large customers. You need to stay on top of your AR. You need to monitor it constantly to make sure people are not continuing to buy from you and they haven't paid you. You can invoice quickly and make payment easier for them. And you need to look at your accounts payable. And most businesses are managing their accounts payable. They're not paying everything on time, and they're definitely not paying early. So you need to know what you need to pay on time and what you don't, and you need to manage it. Also, a lot of business owners have a cashback credit card. I have worked with businesses that are over $100 million in revenue, international businesses with hundreds of employees, where the owner is putting a lot of expenses on their Amex card to get the travel points. So don't think it's just for little tiny companies. Inventory. I just want to point out, I don't have time to get into inventory management, but I want to point out that if you have inventory, your cash is tied up in that. So you need to manage it in order to manage your cash flow. And debt, I just want to point out, you need to be looking at your debt and you have to have a plan to pay it down. If the rate is variable and you can pay down principal, you can do that, but you need to make sure you have that cash forecast so that you don't pay down your debt and then you're stuck 3 months from now without the cash to operate your business. Also, you can consider opening a line of credit to have for the downtimes. The best time to open that is during the up times, when you're doing really well, looking really good. You have a lot of positive ratios that you can show on your balance sheet to the bank. So that's the time to get one in case you need one later. So just in summary, to wrap up, these financial statements need to be accurate for you to make these decisions based on them, because for your business and your value, but also these statements are used when you need to get a valuation of your company for purposes of splitting with a partner or selling your company or doing estate planning for you personally. If you're trying to access capital and get investors or get a loan, you make sure your taxes are done right. For all these reasons, having these statements accurate is important. So just to summarize, just to wrap it up, this financial information on your business's financial statements can be used to help you figure out where you're leaving profits on the table. But the information you're looking at needs to be accurate. And a lot of business owners, just even to calculate your break-even point, all you need to calculate your break-even point is your margin percentage and your operating expenses. And you're just calculating the amount of sales that you need at that margin to cover your operating expenses. And just knowing your break-even point will give you some clarity. You shouldn't be, I just want to leave it with, you shouldn't be needing to call your accountant or CPA for every question. You should know some answers on your own. As a business owner, you should know your sales. You should know your margin. You should know if you're generating enough operating cash to fund current operations and investments. And I hope you got something usable today after this presentation. And feel free to reach out to me if I can help you in your business, or, talk about something that I spoke about today and how it can be applied to your business. Thanks.
Thank you so much, Ivy, for an enlightening masterclass, and on one of the most important topics in business for any CEO and business leader, profitability. Thank you to our live audience and everyone streaming. Don't forget to subscribe to our YouTube channel to see our masterclass library and find the content you need to grow your company and train your top business leaders. And to make it easier for you to see the content that we'll be adding as we release more masterclasses. And to all the CEOs, business owners, and entrepreneurs watching, visit leadingpeers.com to learn more about how Leading Peers can help you succeed. Leading Peers is a premier community for CEOs to connect, collaborate, and grow. Thank you.